Basic Appraisal Principles, page 362, Unit 4, Real Estate Contracts and Financing. January 1st, 2001, FHA's annual mortgage insurance premiums are automatically canceled under specific conditions as determined by FHA. Higher loan-to-value ratio. One important advantage of an FHA loan over a conventional loan is that the down payment requires a substantially lower. The down payment for an FHA loan may be less than 5% compared to the 20% typically required for a conventional loan. However, because the FHA program is aimed at low to middle income homebuyers, there is a statutory maximum loan amount. The maximum varies from one area to another depending on the cost of housing in each area. Interest rates. The FHA does not set maximum interest rates for insured loans. The interest rate on an FHA insured loan is freely negotiable and therefore is determined by market trends in the financing industry. Escape clause. Whenever a buyer intending to use FHA financing signs purchase agreement before an FHA appraisal has been performed, a buyer's escape clause may be included in the agreement. The clause provides that the buyer may terminate the contract if 1. The agreed purchase price is significantly more than the appraised value, or 2. The buyer does not financially qualify for the loan. Assumption. Any FHA loan that was originated before December 15th, 1989 can be assumed without lender approval if the original borrower sells the property. FHA loans originated on or after that date contain due on sale clauses. So the lender must investigate the credit worthiness of the new buyer and give its approval before an assumption can take place. An FHA loan originated on or after December 15, 1989 can only be assumed by a buyer who will occupy the property. And if the loan was originated on or after January 27, 1991, the property must be the buyer's primary residence, not a second home. No prepayment penalty. FHA loans do not carry prepayment penalties. They may be paid off at any time without additional charges. Department of Veterans Affairs, DVA/VA guarantee. After World War II, Congress paid legislation to aid veterans returning to civilian life. Part of this legislation was meant to help veterans buy homes by guaranteeing the repayment of a portion of a mortgage loan made to veterans or guaranteeing the repayment of a portion of mortgage loans made to veterans or their qualified dependents. The Guaranteed Loan Program is administered by the Department of Veterans Affairs, formerly the Veterans Administration, through its Home Loan Guarantee Services Division. Characteristics of VA guarantee loans. A loan with a VA guarantee is made to an eligible veteran by a lender such as a mortgage company, savings and loan, or bank. VA's guarantee on the loan protects the lender against loss if the payments are not made and is intended to encourage lenders to offer veterans loans with more favorable terms. These loans are often made without any down payment at all. In other words, a loan-to-value ratio of 100% is allowed. VA loans also frequently offer lower interest rates than are ordinarily available with other kinds of loans. Page 363. The amount of guarantee on the loan depends on the loan amount and whether the veteran used some entitlement previously. Occupancy requirement. The veteran must occupy or intend to occupy the property as a home within a reasonable period after closing the loan. The loan may only be used to buy a home, including a townhouse or condominium unit in a VA-approved project, to build a home, to simultaneously purchase and improve a home, by installing energy-related features approved by the lender and VA, to refinance an existing home loan or to refinance an existing VA loan to reduce the interest rate, or to buy a manufactured home and/or lot. Eligibility requirements. Veterans who served on active duty and were discharged under conditions other than dishonorable during World War II and later periods are eligible for VA loan benefits. Refer to the VA website for specific requirements. Certificate of eligibility and certificate of reasonable value. Before a loan will be guaranteed by the VA, 2 certificates are required. The first is a certificate of eligibility, which establishes that the applicant is entitled to a VA loan. The second is a certificate of reasonable value, CRV, which is based on an appraiser's estimate of the value of the property to be purchased. Because the loan amount may not exceed the CRV, the first step is getting a VA loan is usually to request an appraisal. Application. Aside from the veteran's certificate of eligibility and the VA assigned appraisal certificate of reasonable value, the application process is not much different from that of any other type of mortgage loan. In fact, the VA application form is the same as that used by HUD/FHA and conventional loans. The mortgage lender verifies the applicant's income and assets and obtains a credit appraised value of the property. If is enough to cover the loan needed, the lender, in most instances, can then close the loan under VA's automatic procedure. Assumption. VA loans may be assumed, and the buyer who is assuming the loan does not have to be a veteran. To assume a VA loan made on or after March 1st, 1988, the new buyer must undergo a complete credit check and obtain the lender's approval. Appraiser's perspective. Appraisers who want to acquire appraisal assignments from the VA must first apply for placement to the VA appraiser panel. Visit the VA website for a list of eligibility criteria and application instructions. VA approved appraisers must comply with the appraisal guidelines as defined by the VA.